All right, now our next guest says the drop in U.S. homebuilder confidence is yet another indication that there are continued challenges facing the housing market in the near term. Michael Fetter is the CEO of housing market research firm Radar Logic. And Michael, you have an index, the RPX index, on which you can see what people expect to happen in the future for housing prices. And what do you see in the futures of the RPX index?
Well, what we see now, Matt, is actually more troubling than what we see today. We're in the middle of the summer, and we should see a lot more activity in the housing markets than we are, and that's what's most concerning. The RPX 25 city composite is basically unchanged from January of 2009. The period from April through August is seasonally the strong period in housing, and if we back out an assumption as to how much activity was generated by the housing tax credit, what we're seeing is the lowest activity in years through the peak season. So what troubles us is as we come out of the peak season with this, if you will, false demand that was pulled forward, we may see the bottom fall out.
Well, that's what I was going to ask you, Michael. Because of that tax credit, I mean, how much does it kind of screw up the numbers here based on what would typically happen in the summer months, but everybody rushing to get it done earlier to take advantage of that tax credit? So it's hard to maybe really accurately look at the data right now, that maybe we have to wait a few months.
Well, it's impossible to tell, Carol, and there have been estimates of anywhere from a 10% increase in activity to as much as a 40% increase in activity as a result of the tax credit. But remember, it wasn't a very large dollar amount, so it had a bigger economic impact on smaller home purchases. And it was initially first-time home buyers, and then there was a lesser amount for additional secondary home buyers. Then they extended the period during which you could close. So in fact, it's the period through the end of June. If you signed your contract prior to the end of April, closed prior to the end of June, you get the tax credit. What we did was to back out of the late June numbers simply 15% of the activity, which felt like a conservative estimate of what those tax credit buyers were doing early, and it just cut the numbers dramatically.
It looks ugly.
What do you expect? I mean, we hear not just the first-time home buyers credit, but there are a number of things the Obama administration has done to try and shore up home prices and hold up the housing market. We talked to Herb Allison, Assistant Treasury Secretary, last week, and he was saying that they're going to help people who are falling behind on their mortgages and have lost their jobs. What do you expect tomorrow from Treasury? Because there's going to be a conference. They're going to talk about probably more initiatives that they've got up their sleeve to hold up the housing market.
Well, look, I think everything the administration has tried so far is great. The problem is they're not addressing the problem. When you look at the National Association of Home Builders sentiment that came out this morning, they indicate in more than one place the problem that home builders have, the reason their confidence is so low, is among other things, and probably most predominantly, they're competing with distressed inventory. There's just too much inventory. Of which the government has a lot. And yes, Carol, as you know, our numbers suggest that in just what's in default now, the liability exposure to the government is $300+ billion, and worst case, even if the housing market stays where it is, that number could approach $1 trillion. So unless the administration and Congress address the Fannie Mae and Freddie Mac existing balance sheets, I don't think they're going to solve the problem.
And that's what they're supposed to be looking at, the fate of Fannie and Freddie tomorrow. I mean, what do you, how do you address the situation? It's gotten to be such a huge problem.
Well, so far, everything they've tried has been a debt-for-debt solution. And with a dramatic reduction in the asset value, debt-for-debt really doesn't work. What we need to do is to attract new equity somehow into the existing housing market. It's not so much the new housing market or the forward housing market. 22 to 23% of all the homes with mortgages in this country are underwater relative to those mortgages.
And we have a story that says your house might be underwater for years, so this isn't looking like it's going to go away anytime soon.
If the government continues to be the largest forecloser of homes and seller of real estate-owned inventory, it will be years. We need to address this problem.
What is the likelihood, though, that, stimulus has been so unpopular, especially as we get closer and closer to November. What's the likelihood that they address that in a way that would make tax holders now shareholders in everyone's home as well?
Well, Matt, it's a very interesting question. But if they don't address it, the taxpayers are the shareholders in everybody's home. And the taxpayers are looking at a prospective bailout that'll make the bank bailout look like a drop in the bucket. So how about an open market, free market alternative that attracts incremental equity into the housing market in a way that's in fact equitable to everybody and doesn't cost the taxpayers money? I'm afraid if we do nothing, the taxpayers are going to write a huge check.
All right, Michael, thanks so much for joining us. Michael Fetter there, CEO of Radar Logic.